Chapter 6, Cost of Funding and Fees. Banks are not in business, not to make money. I think by now we all understand that. I always say go to any major cities, and the biggest buildings and the largest real estate holders are 1, churches, 2, banks, 3, lawyers. So, of course, you should know there are fees associated with all these different lending options. Let's take some time in this chapter to discuss all the fees associated with the 3 funding paths mentioned in this book. I'm going to dissect exactly what you need to know as to how much it's going to cost to you to borrow money on each one of these lending paths. So without further ado, let's get started. What is the cost of credit-based funding? The first obvious fee is the interest rate associated with all lines of credit. As mentioned earlier, the majority of lenders do offer zero interest for the first 6-18 months on newly established credit lines. Then after the introductory period, there's an interest rate charge on a balance on your credit line. In addition to the interest rate, depending on the lender program, there may be an annual fee, also known as a surprise fee, that is paid annually for having access to the credit line. Not all lenders charge an annual fee on their credit line. Some have a $0 annual fee, but it's a fee charge for having the benefits associated with your credit line. There are also balance transfer fees. One unique feature when you have credit lines is the ability to transfer balances between credit lines. A beneficial way to utilize this option and save money on interest is when you have a new credit line with a zero interest rate or one with a lower rate. You can transfer balances for any credit lines you have and immediately start saving. Balance transfer fees usually range between 3 to 5. Another feature with credit cards is cash advances. If you need cash, credit cards have an option to take an advance with the cash advance on the credit lines, but be prepared to pay a hefty cash advance fee. My advice is always to stay away from the cash advance option since the fees tend to be outrageous, but it's an option you have. You can simply go to an ATM and pull some cash out of your card. If you travel out of the country, you can use your credit card, but be ready to pay a foreign transaction fee on the transactions. The one thing unique about credit cards is that you can use them anywhere around the world, but be ready to pay a foreign transaction fee, generally ranging between 1 to 5, depending on the lender. This is only if you travel out of the country. There are, of course, also late fees. To avoid this fee, it's really simple. Make sure you make your payments on time or be prepared to pay a late fee. Late fees usually range between $25 and $50. With all credit lines, there's a preset limit. And if you go above the limit, be prepared to pay an over-limit fee. So I always tell my clients never to go over the limit. What you need to do is simply request a limit increase. This is one option that you have with credit-based funding that you do not have with the other funding options. You can always request a limit increase. I actually recommend that you request a limit increase on your card once every 6-12 months. And what it does is it increases your limit on the credit line, of course, and it clearly increases your buying power, but what it also does is help build your credit as well. Eventually, your goal needs to always be to have higher limit credit lines ranging from 25, 50K credit lines. When lenders see that you have high limits and are managing your credit lines properly, it also legitimizes your business. Later on in this book, I will explain in detail how this can benefit your credit score by having high limit credit lines. Keep in mind, you don't have to use the funds, but it does boost your credit score. Now, when you have high limits, I recommend every 6-12 months, you need to request a limit increase on your credit cards. Another fee associated with credit cards is a return payment fee. This is a fee charged if your payment does not go through. If you have auto payment set as a way to pay the fees automatically, make sure that funds are available on your bank account, because if the payment does not fully process, not only can you get a late fee, but also you can be assessed for a return payment fee by your credit card issuer. What is the cost of revenue-based funding? Now let's discuss fees associated with revenue-based lending. Keep in mind there are different products that fall under the revenue-based lending segment. Revenue term loans, merchant cash advance, factoring loan, purchase order financing, revenue line of credit, etc. So these fees are specific to each product. And also each lender does have their own fee structures and risk tolerance, which does affect the fees they will charge their customers. So generally speaking, These are some of the fees you may be charged if you go for a revenue-based product. Number one, there may be an origination fee. Some lenders may charge you a fee for originating the loan. This is a common fee that lenders charge and some lenders do not. There also may be an administration fee that some lenders charge for issuing the loan. This fee can sometimes be added to the loan, or some lenders may require the fee to be paid upfront by the borrower before they even start underwriting the loan. This fee is sometimes charged to just make sure the borrower is serious. There's a lot of work and due diligence that goes into getting you funded, especially when you're talking about revenue-based lending. Bank statements need to be reviewed. The credit report must be pulled. Due diligence must be done on the business and borrower, which are all costs to the lender. Usually the lender does want to eat all these costs, so by charging you a small fee allows them to recoup these costs. There also may be a maintenance fee. Now, this is very lender specific. Not each lender will charge this fee. It is also product specific. So you want to make sure you read the fine print and ask all the right questions. But this is a fee that is sometimes associated with revenue-based funding. There also may be a wire fee. Majority of the revenue-based funding program, the funds are deposited into your bank account directly through a wire transaction. Some banks charge a fee for receiving a wire. These fees range from $20 to $50, depending on the bank. Also, there's an interest fee now, which is a given. And interest rate is the percentage of principal charged by the lender for the use of its money. You may also hear of a factor rate. Factor rates are used to calculate the cost of certain business financing products, such as merchant cash advances. Factor rates are written as decimal figures rather than percentages like interest rates. As mentioned, and we all know, banks are not nonprofit organizations. They do not lend their money for free. In any major city, look around all the tall buildings out there. They are banks, attorneys, and churches, but mainly banks and attorneys. I always say there are three people that make money around the world: churches, attorneys, and banks, in that order. To prove my point, churches are the number one largest real estate holders in the world. Then you have attorneys that make the rules. Then lastly, you have the banks that offer the funding needed. So in my opinion, that is how it goes: churches, attorneys, and banks. Anyway, this covers all the fees associated with revenue-based lending. What is the cost of asset-based funding? How much will it cost you? Now let's discuss all the fees associated with asset-based lending. As a reminder, asset-based lending covers any type of transaction where the collateral is considered as part of the transaction. This covers all types of real estate loans, equipment financing, stock loans. Since each of these assets are very different in their own, I will try to break it down in this chapter. Let's start off with real estate and discuss all the fees associated with RWA funding. Number one, there is an appraisal fee to determine the value of your home. You will have to pay for the appraisal. The lender will not pay for your appraisal, and sorry to say, but the lender will not take your word when it comes to the value of your property. What a real estate appraisal, property valuation, or land valuation is the process of developing an opinion of value for real property. Real estate transactions often require appraisals because they occur infrequently, and every property is unique, unlike corporate stocks, which are traded daily and are identical. The lender will want you to pay for an appraiser to show them proof that your property value is what you have represented on the application. There's also home inspection. This fee is pretty much a standard if you are purchasing a house. This is a fee that protects the borrower from purchasing a piece of real estate with issues, and also protects the lender from investing in a property with underlying issues that an appraiser is not trained to look for. Basically, so you can understand the difference between an appraisal and a home inspection. An appraiser only focuses on determining the value of the property based on a lot of factors they research. A home inspector, on the other hand, is tasked to evaluate the condition of the property. They check if there is mold, leaks, structural issues, build quality, etc. A home inspection fee is something that is associated with most real estate transactions. Pest inspection fee. The cost for the home inspection, which will satisfy the lender that the home has no major pest-related defects. Application writing fee. The fee associated with reviewing your mortgage loan application. Survey fee. The assessment of a property that discloses boundary lines, gas lines, roads, walls, easements, encroachments, and improvements. But if it's not mentioned in this book, you may want to consider using a different lender. Another big tip that is usually overlooked that can save you thousands of dollars is asking for a seller contribution. This is something that can be easily done, and it encourages most sellers, depending on how bad they want to move the asset, to contribute and help you with the process. You never know, the seller may be able to assist you with closing costs. Some of them may be able to pay some of the fees mentioned here. Some of them may be able to do a seller carryback, or sometimes call it seller financing, where the seller will carry a small percentage of the loan as a second lien to help the borrower with the transaction. Also, no closing cost mortgage is a loan that you may want to consider that can save you thousands of dollars on upfront fees. But be careful. Some of these lenders may just recoup the cost on the interest rate being charged to you. So compare rates offered by no-cost mortgage lenders, but depending on the loan scenario, may still be beneficial to you to save you money. Another very unique tactic that I always share with my clients is signing the loan documents near the end of the month. This can save you hundreds, maybe even thousands of dollars in prepaid daily interest charges. Just this one simple tactic can be very effective in saving you big on fees. You can significantly reduce your cash outlay at closing for per diem interest for the period between your loan closing and the start of the new month. How much can you save? Find out. Let's multiply your loan amount by your interest rate. So for instance, for interest DA4, to find your annual interest charge, dividing that by 365 gives the daily interest charge. Now multiply that figure by the days left in the month to see the savings. It's just that simple. Sometimes when you have a closing scheduled, some sellers will allow you access to the property prior to closing. This can save you big time. The last tip is to ask the bank for any discounts and rebates associated with your loan. Most people don't even know that you can do a rate buy down. There's some transactions where you can actually purchase a lower interest rate. For instance, if the bank is charging 6 initially, you can purchase a 1 rate buy down to bring it down to 5. Now this may increase the closing cost and upfront money, but it can save you thousands of dollars in the long run. Saving money is not just about the upfront cost. You must also take into consideration the long-term saving on a loan. One other tip is, instead of making your payments monthly, make them weekly or bi-weekly. This can save you thousands of dollars. If you think about it, there are 12 months in a calendar, but 52 weeks in a full year. If you make your payment bi-weekly, it forces you to make one additional payment annually, which on the term of the loan can significantly save you thousands on interest. If you visit www.3pathsfoflending.com, one of the bonus tools we offer on the site is a calculator that shows you how much you can save on interest by paying your payment weekly or bi-weekly. But this is one of many benefits you get from working with an expert in the industry like Pennington Consulting Group. All associates are trained to look out for your best interest. We do not work for banks. We work for you, the borrower, and our loyalty is to the borrower. As our mission statement reads, our goal is to help you reach your goal. We focus on long-term relationships with all our clients, so keep us in mind for your next business funding needs. To summarize here, in short, make sure you are engaged through the transaction and understand the whole process. Choose to work with people who only have your best interest in mind.